The U.S. economy from 1977 to 1980 was defined by severe stagflation, a toxic combination of sluggish economic growth, soaring double-digit inflation, and spiking unemployment. Triggered by the 1970s energy crises, this era fundamentally reshaped American fiscal and monetary policy. Buffett was already building a machine that most investors would still struggle to understand today. This story begins with Buffett's shareholder letters from 1977, the years when he was already laying the foundation for Berkshire's long-term compounding power. Charlie Munger was the intellectual architect of Berkshire Hathaway, transforming Warren Buffett's traditional deep-value cigar butt strategy into a framework of buying wonderful businesses at fair prices. Reading the letters through his multidisciplinary latticework of mental models provides a unique lens on the conglomerate's evolution from 1979 to the present. In the 1977 shareholder letter, Warren Buffett outlines an investment approach focusing on return on equity, long-term prospects, and quality management, prioritizing business value over short-term price movements. He advises against including capital gains in annual operating earnings and views stock market declines as buying opportunities for businesses deemed worthy of acquisition. In the 1978 shareholder letter, Warren Buffett reinforces Berkshire Hathaway's core operational and investment philosophies while highlighting a critical structural risk within the insurance industry. The text outlines three fundamental principles. 1. Long-term optimism versus short-term market agnosticism. Buffett explicitly states that Berkshire makes no attempt to forecast short-term stock market movements, believing it to be impossible. However, he remains highly optimistic about the long-term value of their major equity holdings, expecting investment gains to significantly boost the insurance group's long-run returns. 2. The danger of self-delusion in insurance pricing. A central warning in the 1978 letter focuses on the reinsurance sector, particularly long-tail casualty lines where claims take years to settle. The mechanism. Competitors often fool themselves by underestimating future claim liabilities. Reserves, looking at early low claim volumes as a false sign of profitability. The market fallout. This self-delusion leads these competitors to underprice their premiums to win market share. Because rational companies must compete against these artificially low rates, the undisciplined players drag down pricing across the entire industry, hurting everyone. 3. High conviction, concentrated investing. Buffett reiterates his strict four-part criteria for equity investments: understanding the business, favorable long-term prospects, competent management, and attractive pricing. Because finding all four criteria simultaneously is rare, Berkshire's policy is to avoid mediocre investments, lukewarm ideas, and instead concentrate holdings by investing heavily when a truly attractive opportunity is identified. Warren Buffett outlines a capital allocation strategy favoring the retention of earnings by companies capable of high internal reinvestment rates, while recommending dividends or buybacks for those lacking profitable opportunities. This philosophy introduces look-through earnings, where Buffett considers retained earnings from minority holdings just as valuable to shareholder wealth as reported operating income, particularly when market conditions allow for purchasing underlying earning power at a discount. Warren Buffett's analysis highlights that companies should retain earnings only if they can generate a high return on invested capital, ROIC, using Coca-Cola as an example of efficient capital allocation. In contrast, in long-tail lines like asbestos, undisciplined reinsurers often fail to account for long-term claims, causing industry-wide price deterioration. A company must recognize IBNR, incurred but not reported reserves, to avoid the fatal delusion of booking early, deceptive profits. In the 1979 shareholder letter, Warren Buffett addresses a major shift in generally accepted accounting principles, GAAP, that forced insurance companies to carry equity securities at market value rather than the lower of cost or market value. Because Berkshire held massive unrealized gains, this accounting change significantly inflated its reported net worth for 1978 and 1979, even after setting aside liabilities for future capital gains taxes. However, this rule change created a bizarre accounting paradox on Berkshire's consolidated balance sheet involving blue chip stamps, a 60% owned subsidiary, the insurance subsidiaries, required to report stock holdings at current market value. Blue chip stamps, still required under old GAAP rules to report identical stocks at the lower of cost or market value. The result: if Berkshire's insurance arm and Blue Chip bought the exact same stock at the exact same price, they were valued differently on the same consolidated balance sheet, prompting Buffett's witty reminder to keep shareholders on their toes. The interconnected theme: accounting versus economic reality. This 1979 accounting mismatch ties directly into the other core themes you highlighted from 1978 and 1980. Buffett routinely uses these letters to show that official accounting numbers often mask true economic reality. The delusion of paper profits. Just as GAAP rules in 1979 created artificial balance sheet variations, weak reserving in long-tail casualty lines allowed bad reinsurers to book fake short-term profits. By ignoring ultimate claim costs, which take decades to surface, like asbestos, these competitors ruined industry pricing before inevitably collapsing. The power of invisible wealth, 1980. Conversely, accounting rules forced Berkshire to omit retained earnings from minority stakes, like Coca-Cola, from its official operating income. Buffett looked past this reporting limitation, treating these invisible, look-through earnings as highly valuable capital, provided management efficiently reinvested those funds at a high return on invested capital, ROIC, rather than wasting them on low-profit projects. Warren Buffett's $1 test serves as a primary metric to determine if retained earnings create at least $1 of market value, separating efficient capital reinvestment from value-destroying capital traps. Modern portfolio management often favors share repurchases over dividends for tax flexibility and per-share compounding, while look-through earnings calculate the true economic value of ownership beyond just reported dividends. For a detailed analysis of Buffett's principles, you can explore in-depth, user-driven case studies and financial models on Berkshire Hathaway's investment strategies. Warren Buffett's letters from 1977 to 1980 illustrate that accounting rules, such as those governing asset valuation and insurance reserving, can distort economic reality and lead to self-delusion in corporate reporting and underwriting. Modern FASB rules, ASU 2016-01, exacerbate this by forcing unrealized investment volatility into quarterly income statements, making bottom-line figures misleading and prompting a focus on operating earnings. Consequently, in long-tail lines, competitive pricing based on misunderstood costs rather than accurate reserves can lead to industry-wide insolvency. Buffett has repeatedly blasted this accounting rule for being highly confusing to the financial press and everyday investors. He urges shareholders to completely ignore bottom-line GAAP net income and focus exclusively on operating earnings, which isolate the actual steady earnings power of Berkshire's business units. Warren Buffett views deferred tax liabilities, DTL, arising from unrealized gains as a financial gift from the government, a permanent interest-free loan with no covenants and no fixed maturity date. Alongside insurance float, it acts as a massive free leverage mechanism. How the financial math works. Suppose Berkshire purchases a stock for $10 per share and it climbs to $110 per share, creating an unrealized gain of $100 per share. Assuming a federal corporate tax rate of 21%. Accounting entry: Berkshire creates a $21 deferred tax liability on its balance sheet to prepare for the tax that would be due upon liquidation. The loophole: as long as Berkshire never sells the stock, that $21 cash is never handed over to the Internal Revenue Service, IRS. The compounding effect: that $21, which technically belongs to the government, remains fully deployed inside Berkshire's investment portfolio, compounding and generating returns for Berkshire's shareholders. In his 1980 letter, Warren Buffett demonstrated that ignoring GAAP rules to retain earnings in high-growth minority-stake stocks, like GEICO, was superior to switching to tax-free bonds, despite a potential $30 million boost in reported earnings from the latter. He prioritized high-return internal compounding over cosmetic earnings, rejecting fixed-income assets that would be eroded by inflation. Through his hamburger economics framework, Buffett emphasized that true investment returns must outpace the combined forces of inflation and taxation to increase real purchasing power, rather than just nominal paper wealth. In his 1980 letter, Warren Buffett also exposed a hidden crisis within the insurance industry, introducing what can be described as the desperate battle of zombie insurers. Driven by skyrocketing macroeconomic interest rates and high inflation, this era perfectly illustrated how accounting cosmetics can mask structural insolvency and trigger irrational market competition. The anatomy of invisible insolvency. During this period, the insurance industry faced a pincer movement of operational losses and collapsing asset values. The deteriorating combined ratio. The industry's combined ratio climbed from 100.6 in 1979 to an estimated 103.5 in 1980, meaning insurers paid out $103.50 in claims and expenses for every $100 collected in premiums. Buffett accurately predicted that these underwriting losses would worsen through 1981 and 1982. The amortized cost cosmetic shield. To prevent widespread panic, regulators permitted insurers to carry long-term bonds on their balance sheets at amortized cost, historical purchase price. This rule completely ignored the reality that surging macroeconomic interest rates had caused the actual market value of those fixed-rate bonds to plummet. The leverage breakdown. Many major insurance companies held long-term bond portfolios valued at 2 to 3 times their stated corporate net worth. Buffett highlighted the brutal math. A mere 33% drop in bond market prices would completely wipe out their entire equity base if marked to market. When valued at true market prices, several of the largest and most prominent insurers of the time were functionally insolvent with negative net worth. This irrational behavior was driven by pure survival. These companies were desperate for immediate cash flow to settle ongoing claims and cover operational expenses. If they stopped selling underpriced policies, their incoming liquidity would instantly dry up, forcing them to liquidate their cratered bond portfolios and declare official bankruptcy. They were effectively running a legal cash flow treadmill, dragging the entire industry's pricing down with them. Macro lessons for the modern investor. Buffett dismissed short-term macroeconomic forecasting as entirely useless, famously writing, "The forecasts may tell you a great deal about the forecaster, they tell you nothing about the future." Instead of guessing where interest rates are headed, investors must protect themselves by rigorously analyzing structural balance sheet risks, the direct line to the 2023 banking collapse. The structural illusion Buffett criticized in 1980 is the exact mechanism that triggered the modern banking crisis decades later. In 2023, financial institutions like Silicon Valley Bank, SVB, collapsed because they parked billions in long-term, low-yield treasury bonds during a low-interest rate environment. When the Federal Reserve aggressively hiked rates to fight modern inflation, those bonds lost massive market value. Just like the 1980 zombie insurers, SVB hid these losses on the balance sheet under the accounting classification of held-to-maturity (HTM), or amortized cost. When a sudden run on deposits forced them to sell those bonds at a loss, the invisible insolvency instantly became a visible bankruptcy. Investor action plan. Never buy a financial or insurance stock based purely on its superficial trailing price-to-earnings, P/E, or price-to-book, P/B ratio. To find the true economic reality, you must open the financial statement footnotes and inspect the held-to-maturity, HTM, or amortized cost columns. If a bank or insurer holds a long-term fixed bond portfolio that amounts to several multiples of its stated net worth, it is structurally exposed to macro rate shocks. A prolonged high-interest rate environment will silently hollow out its true economic equity, rendering it vulnerable to a sudden liquidity shock. Between 1980 and 1985, the American macroeconomic landscape underwent a violent structural shift. This era transitioned from the peak of 1970s stagflation into a period of aggressive disinflation, creating the exact corporate crucible that shaped Warren Buffett's most famous frameworks on inflation, capital intensity, and business quality. 1. The inflation corporate tapeworm Buffett introduced a powerful biological analogy during this high inflation era, describing inflation as a corporate tapeworm, the illusion of paper profits. In a standard environment, higher sales and rising profits signal business growth. Under high inflation, however, this profit is often an accounting mirage. The capital drain. The inflation tapeworm silently consumes a company's cash. To sell the exact same physical volume of inventory or maintain the same machinery, a business requires vastly more nominal dollars. Every dollar of reported profit is instantly diverted into expanding working capital, receivables, inventory, and higher capital expenditures just to stand completely still. Consequently, the company produces zero free cash flow for shareholders, destroying its real purchasing power value. 2. Asset-heavy traps versus capital-light winners. The corporate tapeworm did not affect all industries equally. This period solidified Buffett's structural preference for asset-light businesses over capital-intensive operations. The asset-heavy trap. Businesses that relied heavily on physical plants, property, and equipment, like Berkshire's legacy textile operations, steel mills, or automotive plants, were devastated. To replace aging equipment at inflated prices, they had to plow every dollar back into the business, yielding miserable real rates of return. The capital-light winner. Buffett championed businesses anchored by economic goodwill, companies with strong consumer brands, low capital needs, and genuine pricing power. The ultimate case study was See's Candies. See's could instantly raise its prices to match inflation without needing to build expensive new factories or heavily expand its inventory. It passed the inflationary burden entirely to the consumer, allowing the cash to flow directly out of the business and into Berkshire's hands for reallocation. Re-evaluating incremental capital returns. During this period, Buffett actively re-educated shareholders to look past superficial metrics like record earnings per share, EPS. If a company reports record earnings but required massive, disproportionate equity injections or debt capital to achieve them, the performance is actually poor. The true measure of managerial excellence is the return on incremental invested capital, ROIC. If a management team retains $10 million of shareholder earnings but can only deploy it at a 4% return during a period of high inflation, they are actively destroying shareholder wealth. The Volcker Medicine and Recession, 1981 to 1982. To permanently break the back of the 1970s inflation cycle, Federal Reserve Chairman Paul Volcker pushed the prime lending rate to an unprecedented 20.5% in 1981. This massive monetary tightening triggered a severe, painful recession. Unemployment peaked at a post-WWWII high of 10.8%, crushing weak corporate balances. The disinflation shock, 1983 to 1985, the harsh policy worked. U.S. inflation plummeted from a staggering 13.5% in 1980 down to roughly 3.8% by 1985. The Great Market Pivot. As interest rates eased and inflation cooled, the corporate tapeworm was starved out. Companies with strong economic moats suddenly saw their cost pressures drop while retaining their newly adjusted pricing power. This powerful combination of falling interest rates and surging corporate efficiency ignited a massive, multi-decade stock market bull market starting in late 1982. The post-1982 economic decoupling and structural breakout, when Federal Reserve Chairman Paul Volcker successfully broke the back of inflation, causing interest rates to descend from their 1981 peak, Berkshire Hathaway's financial engine completely decoupled from the broader market. Buffett's aggressive discipline during the stagflationary, high-jump crossbar years paid off exponentially. The book value surge. Berkshire's per-share book value grew by 31.4% in 1981 and 32.1% in 1983, drastically outpacing the S&P 500. This was the direct result of buying compounding machines when the market was gripped by macro panic. The strategic pivot. While competitors were trapped on the cash flow treadmill of the zombie insurer crisis or fighting the inflation tapeworm in asset-heavy industries, Buffett had built a fortress of capital-light subsidiaries and heavily concentrated equity stakes. The historic closing of the textile mills, 1985. By 1985, Berkshire's compounding machine was so dominant that Buffett made the difficult, definitive choice to permanently liquidate the legacy textile manufacturing mills. This final move cut the cord on the asset-heavy, low-return drag that had birthed the company, ensuring 100% of Berkshire's capital was allocated to elite, high ROE operations. Through this entire corporate era, Buffett's thesis remained entirely unified. Always choose real economic compounding over cosmetic accounting presentation. Whether navigating the mark-to-market paradoxes of the 1970s, the invisible insolvency of 1980 bond-heavy insurers, or the modern accounting distortions of ASU 2016-01, the lesson is identical. An investor must always look past headline net income, calculate true operating earnings, evaluate the return on incremental capital, and invest alongside managers who protect your money from the dual erosion of inflation and immediate taxation. Warren Buffett shifts his focus from accounting distortions to the behavioral traps of corporate mergers and acquisitions, M&A, 1982 letter. He codifies why strategic inaction is often a company's highest-yielding decision, providing a psychological blueprint that explains his patient, multi-decade approach to cash management, 1982 letter. During the corporate buyout boom of 1982, Berkshire Hathaway consciously sat on the sidelines. Buffett observed that in large-scale bidding wars, managerial intellect wilted in competition with managerial adrenaline. Corporate executives frequently decouple their purchasing decisions from strict economic reality, becoming entirely consumed by the competitive thrill of winning the auction, 1982 letter. To ground this corporate pathology in human psychology, Buffett cited the French philosopher Blaise Pascal. All men's misfortunes spring from the single cause that they are unable to stay quietly in one room. In corporate finance, this translates into an addictive urge among CEOs to execute large transactions simply to appear active, even when doing absolutely nothing is the mathematically superior strategy. If an investor or CEO overpays at the point of entry, even for an absolutely exceptional business with an ironclad moat, that initial valuation error can completely cannibalize the economic benefits of a subsequent decade of favorable business growth. The math of compounding is highly sensitive to the initial purchase price, and no amount of managerial brilliance can outrun an overvalued starting multiplier. The first whammy, loss of intrinsic value. The underlying pro rata net asset value and true earnings power per share are instantly diluted. 1982 letter. A portion of the original shareholders' wealth is legally transferred away to the owners of the newly acquired company. The second whammy, the valuation penalty. Wall Street is highly rational over the long term. Once investors witness a management team executing wealth-destroying deals, they will systematically downrate the company's valuation multiple, slashing its P/E or P/B ratio. Investors understandably refuse to pay a premium for corporate assets managed by an executive prone to ego-driven expansion. This structural price-to-value discount can cause a company's stock to chronically underperform its industry peers for a decade, completely trapping shareholder capital. If you discover a cockroach in your salad, an immediate apology from the head chef or a change of waiters does not restore your appetite. The demand, and therefore the intrinsic value, for those salads plummets instantly. Not only will the offended customer refuse to buy it again, but all the neighboring tables who witness the event, representing prospective new public investors, will quietly change their orders as well. In corporate governance, capital discipline is a one-way street. Once a management team demonstrates that it is insensitive to the economic interests of its owners, the damage to corporate credibility is permanent. In his 1983 letter, Warren Buffett formalized Berkshire Hathaway's owner-related business principles, a set of rules ensuring management's financial interests are perfectly aligned with shareholders through extreme equity ownership and the rejection of corporate perks. The framework prioritizes maximizing per-share intrinsic value over company size, utilizing a flexible capital allocation strategy that switches between acquiring private businesses and investing in public equities based on valuation. Warren Buffett's 1985 letter marked a shift to evaluating Berkshire Hathaway through segment data rather than consolidated statements to reveal the true economic reality of individual businesses. By analyzing segment earnings, Buffett exposed how consolidated figures can disguise poor performance in specific units, citing the liquidation of the textile business as a necessary, albeit delayed, action to prevent further cash drain. His analysis highlighted the power of economic goodwill, where superior businesses generate high returns without heavy capital reinvestment, and provided a framework for evaluating management based on return on capital rather than capital-intensive growth. The U.S. economy from 1985 to 2000 transitioned from a period of restructuring and disinflation into the longest peacetime economic expansion in American history, ultimately culminating in the late 1990s new economy tech boom. This 15-year era was defined by a massive shift from traditional manufacturing toward information technology, globalization, and service-based industries. If you want me to keep breaking down Warren Buffett's legendary shareholder letters from 1985 to 2000, drop a comment right below this video saying, "Keep going." We are officially stepping out of the dark days of 1970s stagflation and entering the wildest, most explosive 15-year macroeconomic expansion in American history. This is the era where Berkshire Hathaway truly transformed from a multi-million-dollar insurance group into a multi-billion-dollar economic empire. If we move forward into the 1985 to 2000 masterclass, I am preparing a massive series of exclusive case studies and financial models for you. Tell me in the comments if you want the next chapter. See you in the next video.